What's up? Welcome to the Confluence VC podcast. This podcast is meant to give you a personal glimpse into the next era of investors and operators. This week we had on Ryan Bloomer and Adriel Bercow of K50 Ventures. K50 is a global venture firm that invests in early, mission-driven founders transforming the world's biggest industries. Within their roles, Ryan and Adriel are in charge of finding and supporting founders challenging the status quo in essential categories like health, education, housing, finances, and work. In this talk, we discuss heightened employee demands and the challenges for modern benefits, the complex future of remote education, reasons to be optimistic in the Latin America startup scene, and investing with a mission-driven thesis.
Yo, everyone. We're very excited to come kick it with you all today. We've got some dope people in from K50 Ventures, spinning off of the Kairos family, which I've been really close to since I first joined VC, because Jake Medwell was one of my first folks to really show me the game over at AVC, and he's in love with these people. With that, I would love to introduce Ryan and Adriel of K50. We also have a few other members of their team on. Jessica, what's up? If you want to stop and say hello really quickly. And yeah, we'll be kicking it off with our first podcast ever where we have more than one person speaking with us. Clay and I are excited. I'll let you all decide how to do this. Ryan and Adriel, how about you all give us a quick 1 to 2 minutes on how you met and the story behind K50?
Cool. Yeah, I'll take that one. Tyler, this is Ryan Bloomer. It's funny that Jake met. I've known Jake since I was a kid, since I was a teenager. In any case, K50 also has a pretty long history. So K50 Ventures has really been in the works since 2008. And for those of you that know Kairos, that's when Kairos started. It started off as the Kairos Society, and we would host an annual summit for the Kairos Fellowship each year. So we would put the spotlight on 50 amazing, mission-driven entrepreneurs from our community, and we called that the Kairos 50, or the K50 for short. So we'd have these summits, and we'd have them in, the first summit was actually in New York on the Intrepid Air Museum, but we've had some at Warner Brothers Studios in Laguna Beach, all the way back from 2008. And so, in fact, I was actually one of the first K50 founders at the first summit on the Intrepid Air Museum, and where I actually met a lot of my now friends. So like some of the other Kairos fellows that were part of Kairos went on to build companies like Casper, Brex, Oil Rooms, ClearMotion, Owlet, which actually just went public, Freenome, etc. And basically it became a global community, and we were in about 40 different countries. And eventually we started our first fund back in 2016. And so with our first fund, we built companies, so like incubated companies from the ground up, and we invested in companies. And in 2020, we realized we had this huge global community in 40 different countries. And at the same time, we were basically running two different investment strategies on the building side and on the investing side. So on the building side, we ended up basically turning into a venture studio. So we have now 5 companies in Kairos HQ. And then on the investing side, we had 130 investments. And we said, you know what, this makes a lot of sense to just split this up into 2 different teams and basically build out the platform for K50 Ventures. So back in 2019, we made the decision, and in 2020, we actually made it happen. And in March, we hired our first person at K50 Ventures, who's really been my right hand. And it's somebody that I knew I needed in order to do this properly, which is Adriel. And Adriel and I met back when he was at Flybridge. We would co-invest in some companies together. And he'd always send us these like fire deals from Flybridge that he was looking at on the pre-seed side. And we met a bunch of people through the process, but Adriel really was the only one that had the experience of investing in early stage, like the hunger to build something big virtually from scratch. And we were essentially starting anew. And then the passion to back mission-driven founders, which you'll hear about later, which is was core to our mission, and it's been a great match. It's been incredible to build the next iteration of K50 together.
I love it, man. I love it. I think that so Clay and I have been doing the Confluence Access Fund and Syndicate, and we were talking about like how do you actually. And what was really cool is we came to the conclusion that the only things that truly make outsized returns over time, like you'll see some really cool tool that increases productivity across a specific function within a specific vertical within a specific part of their values. And that might make some people a lot of money, but unless they go out and expand and become something that truly changes the lives of those operators of that industry to like a broader customer set, it doesn't really produce that 50, 100, X billion-dollar company. And what I really love about what Kairos does is you all truly do, you're saying, try to impact the lives of the biggest population possible, like quite literally the 99%. You all wrote about that a lot in your 2021 manifesto, like from everything from housing to modern benefits and a myriad of other things. Can you all dive a little bit more into some of the opportunities you're excited about from the 2021 manifesto piece?
Yeah, absolutely. This is Adriel. I'm happy to take that one. You mentioned modern benefits, which I think is as timely as it ever is, especially with COVID. The HR tech space, the benefit space is something that I've been spending the last 4+ years at. While I was at Flybridge, where we had a deep focus in the future of work, I started to notice this paradigm shift where really the employees were, or consumers were shifting what employers were providing them in terms of benefits. So whether that's around wellness, fitness, even food, childcare. And if an employer wasn't providing these employees the right tools to be successful in the workplace, they're leaving. And that's part of the environment today where you have a ton of churn. You have, by the time you're 30, 32, you have employees who've been in almost 10 different jobs. It's become pretty crazy. And part of that is the employees are actually demanding what they need in order to be successful. Especially with COVID, there's been this shift toward obvious things, right? You have remote work being a new challenge for people, right? They're not commuting to the office. There's no company culture. You're missing those water cooler moments of working with, managers and colleagues. You're missing out on some of that learning and development moments. You're missing out on building those cultural moments within your company. You're suddenly forced to be, whether it's at your home or somewhere else, trying to figure out the right way to be successful in your job, within your team. Then you have, other things that people have been talking about, right? Everything from mental health. So just the challenge of something as simple as Zoom fatigue or just feeling isolated, feeling lonely. You have employees struggling with childcare, right? I think there's some crazy numbers out there, such as, I believe it's almost 5.5 million women have lost their jobs since COVID. And the challenge of managing your family, managing your work has become obviously top of mind for a lot of people. So what are they doing? They're finding employers or finding companies that are actually solving this for them. So when we talk about what are those shifts happening in the modern benefit space, it's looking at the companies that are making a workplace more powerful for these workers. So that's everything from, I mentioned childcare, right? So we've invested in companies like Winnie and Kinside, which is a company that is targeting employers to really expand the market for childcare as an employee benefit. So, providing those tools for someone to be successful in that workplace. And I think that's going to continue to shift. Like you see companies like Papaya Global, where it's focused on that distributed workforce internationally for companies. So as we go into more of a remote work environment, how are employers providing those tools and resources to that distributed workforce? But yeah, all in all, I think it's a super exciting space. Obviously, a lot of activity from both M&A, from downstream capital. A lot of opportunities to be supporting these employees.
True that. To pivot a little bit, you also talked about the opportunity for better digital learning tools. So Clay and I have heard a ton of conflicting debate over whether remote education benefits or whether remote education either benefits or hurts kids. And we'd love to hear your thoughts on it because it seems like an obvious transition that we probably can't avoid, but there are some secondary and tertiary impacts that we may or may not see. What are your thoughts?
Let me ask you, so what type of challenges are you hearing about or thinking about?
So from my first take, which Clay, you can hop in here as well. My thought is that I think personalized education is amazing. I think digitizing education in terms of having educational quality is phenomenal. But I also think that there are a lot of in-person, call it behavioral traits that are learned that you only can get in person through natural bump-ins with your peers and working in group settings. And we are effectively mammals that work in herds in practice, and we need to get those skills as much as we can. Maybe as the world evolves to being digital, that'll be less important, but I do think that having children in isolation is pretty harmful. Like my thought was that kids who are in their like early developmental states, call it ages like 3 to 8 to maybe 8 to 10 or something like that, those people or those children who are going through their lives on remote platforms probably are missing a lot of development that are very key at that age. Clay, do you have any thoughts?
Yeah, I can just echo that. I think some of the opinions we've heard around the development of soft social skills at transformative ages, say like 5 to 10, that's obviously something that's lacking in a remote first world. So I don't know, we'd be interested to hear you guys take on that, because we've heard the other side of the coin as well, of all the benefits that are coming with remote education. But just wanted to hear how you guys are thinking about it.
Yeah, you both bring up good points. I think as far as the soft skills, I think it's something that even pre-COVID has been top of mind. Again, talking about employers, and top of mind for them. Of how do we support these employees in actually having the right skill sets, soft skill sets to be successful in the workplace? And with the way we see e-learning and this remote education is twofold. One is the opportunity, right? The opportunity is that you've now made education accessible to many more people, right? So you have people who are, let's give you an example. There's a virtual high school company that we spent some time with, and you have some of their students who are now doing project-based learning with someone who might be in Atlanta, Georgia, with somebody in Seattle, somebody who they may have never been able to connect with. We're going through that educational experience, having hands-on personalized learning, something they may have not gotten within the public education system, at a price point that's now affordable to those family members, right? So you're also increasing that opportunity by having a price point that is more affordable, more accessible to the population. So beyond the access and the affordability piece, I do expect that, and this is something we look for in the companies we're investing in, education models that are being built for the 21st century. So what I mean by that is, if you look at today's education system, it's really fallen behind the digital economy, right? So when people graduate from high school, graduate from college, that maybe that liberal arts degree isn't going to resonate with that tech industry, or the working in an environment that requires some of those digital skill sets, or even some of those soft skill sets. And so what do we look for? We look for companies that are building those tools in order for somebody to be successful beyond that education system. So when we look at exactly what I mentioned, this high school company, how are they doing project-based learning to integrate doing digital experiments, being able to actually maybe code a game together, and to learn how to collaborate, to learn how to be creative, right? And those building some of those soft skills is going to be essential as they enter into adulthood, as they enter into the workforce. The last thing I'll mention is that I think right now we're forced to be in this remote environment, but I think the shift that's going to happen is a hybrid model. Because I completely agree with you guys. Like that experience that we've all grown up with, is being able to hang out with friends in the hallways or play sports or something after school is crucial to growing up, to that school kind of personal experience. So I expect there's going to be hybrid education models that are leveraging the more commoditized online content, but also building that personalized experience for people to be able to enjoy the experience of growing up together.
And I would just follow up on that. I think that the main one of the big things that we focus on when we're looking for founders to reinvent a particular product or service within these pretty old industries, healthcare, food, financial services, et cetera, and education as well, we're looking at founders that usually can go full stack, so can actually build the whole entire product or service from start to finish. And that basically just gives them the control to then own pricing, be able to provide credit, and really be able to provide that product or service and own every single element of it. And I think that's something that we look at across any one of the problems that we're looking to solve. So I thought I'd mention that because I think it's a big differentiator for us.
Got it. Yeah, I think it makes a ton of sense. Ultimately, as someone from I guess I don't want to call it underprivileged background, because like my parents are phenomenal, but like for someone who didn't go to the best schools in the world when I was coming up and didn't have an abundance of opportunity, like I think that if you can somehow normalize the actual learning context, like for instance, like kids who have 10, 20-year-old books relative to people who are getting the new editions written by their exact professors every year, depending on like your level of privilege in the education system, where you fall in the stack. I think if the benefits of that, along with what you're speaking on in terms of people being able to meet outside of their existing social circles, far outweigh like them meeting the benefits of seeing people in person in their immediate neighborhoods. And I think you could probably also find either one, a way to supplement that or fix that through like maybe childcare or like just having like social opportunities in your communities, which now that you have all this free time and like additional capital.
100%.
Yeah, you can just fix that, right? It's not if we can fix something as complex as all the other stuff we're talking about, we can't find a tech solution to fix the social dilemma that we're going through. So you all are on point, and I'm personally like, I'm going to track your portfolio in that space like incredibly closely, and hopefully at some point co-invest you all, because I think you're on point. I've talked to a lot of ed tech investors, and I think you all's perspective is refreshing, especially because of your worldview. Let's see. Speaking of worldviews, Clay was talking about you all's investment thesis or investment focus in Latin America. I would love to hear about your views on the Latin American startup scene. I spent a ton of time looking at it when I was at Point 72, but only from the fintech lens. And I would love to believe that I would love to understand why you now believe that it's the right time to invest there.
Cool. I will take that. And mainly because I've been investing in Latin America since we launched our first fund in 2016. And it's funny, I ended up investing in multiple companies within the first fund in Latin America for a couple of different reasons. One, I just love the culture and I have a lot of friends down there. I love the culture. It was always a lot of fun to go and visit. But to be honest, I think the big thing that attracted me to the region, beyond having very good friends and being connected in the region, which made me feel comfortable as an investor, was the fact that like our mission resonated so well within the region. Because if you look at it, if you're building we're mostly B2C for the most part. I would say we do some B2B investing, mainly when we're looking at how do we build up infrastructure within a space to then be able to deliver a consumer product or service. But for the most part, we're B2C. And if you're building a B2C company in Latin America, you're going to have to serve the everyday person, or else you're not going to have a business. And that was what really resonated with me, and I think for like us and our mission, it made a lot of sense for us, and that's why we ended up going down there. What was interesting though is after I made a few investments, I actually had to re-pitch the opportunity back to my partners. And so to Alex and Encore and Katie, when we were doing the first fund, and we ended up starting a new, right after we created the first fund, we ended up starting a fund specific called the K50 fund, which is where kind of the K50 funds came from, where we started investing in 50 companies within a portfolio. And one of the reasons why we did that was because we were investing in a lot of companies outside of the US. And because we didn't want to put in the amount of companies into our initial fund, we didn't want to have more than 10-15% of our portfolio be Latin American companies. So we ended up starting the K50 fund. So it's actually what kicked off this kind of K50 mini franchise under Kairos, which is a funny aside. But what's been really interesting is to see the opportunity multiply by 10x. And this is just in the last few years. So most of the big opportunities are businesses solving problems for consumers or SMBs within Latin America. And you'll see the big companies that are doing really well are either in fintech, transportation logistics, or marketplaces. So you see Rappi, Logi, Nubank, etc. Now, to get into the numbers a bit here, and we're going to be putting out a blog, so look out for that, so that for all of our friends in the US, they're looking at and investing in Latin America, we'll have a good kind of primer for you. Although there is some info, I think that I'll give you a kind of a preview. So basically, there are over 650 million people throughout Latin America. Now, in order to reach a large portion of those people, you need to be in Mexico and Brazil. This accounts for almost 50% of the 650 million. I think it ends up being like something like 321 million. It's really close to 50% of the population is based in Brazil and Mexico. And then Colombia is the next biggest market as far as the country is concerned from a population perspective. That's actually where we started. So we landed in Colombia for multiple reasons. One, we had an LP down there and their family office was extremely helpful and was very interested in investing into early stage companies, which was great for us. Now that person is an anchor LP of K50 Ventures and is also a venture partner. So like we've definitely grown our relationship within the region and with the folks that we started there from back in 2016, which has been really cool. Now, the consumer market has always been there. Like, it's not like there's just been this like influx of people into Latin America. I think the other thing is like mobile or like internet penetration, for instance, which is like what Mary Meeker looks at when she's looking at like a market in terms of specifically when consumers are like how many people are actually adopting like digital tools, above 70%. And I think it's been that way for almost 10 years. But the big change in the last 5 years and really in the last couple of years was access to capital. I feel like there were always entrepreneurs. It's not like there was a lack of, I guess there is a lack of technology taught in secondary schools, which is, I think, a big challenge that the region's going to have to face as they continue to grow exponentially. But the biggest thing was access to capital, and that's access to downstream capital, which has changed. So VC funding has been doubling each year for the last few years, and exit potential. So back in 2016, 2017, when I started to make a few investments, the first few investments, again, I had to pitch my partners on the actual opportunity of can this company actually exit? Not, oh, is this going to be a big company? It's, are they going to have access to capital or are they going to be able to exit? And so we finally have started to see exits. Like we've seen exits happen from Uber, for instance, is buying companies in Latin America. Didi from China is buying and a lot of other Chinese companies are looking at Latin America to expand into. In addition, family-owned traditional businesses are now both investing in a big way and then also buying digital native startups, which never happened in the past. And with SoftBank coming in and having a $2 billion checkbook to write checks into companies, as well as a lot of US investors. So you'll see Andreessen Horowitz, you'll see Foundation Capital, and you'll see a ton of early stage investors that are now, I would say, quote unquote, focused on LATAM, which has really been in the last year. This has really opened up the playing field for entrepreneurs in the region, and a lot of entrepreneurs that are coming back to the region saying, I want to build something for my country and for the folks that I've grown up with, which has been really interesting. Now, we're still very early, and early stage valuations are already being pushed up by YC, go figure. But I think if you're a US-based investor looking to take advantage of the opportunity, I would really think about getting on top of it ASAP. It is one of those things that I think it's going to get pretty crowded pretty quickly. We're already starting to see that.
I'll just add a little anecdote to that's just happened. One of our pre-seed companies, which actually is an education space based in LATAM, is starting their fundraising process. And friends who I've spoke to maybe 6 months ago at Fund and Bercow who would not even think about taking a look at a seed stage company be a LATAM based company are excited to meet teams that are building these LatAm companies. And I think we're going to see a lot more downstream capital getting aggressive, getting excited about investing into that space.
Got you. Yeah, I was not surprised to see, but like I was happy to see the amount of LATAM-based companies starting to come into the YC folds. And it actually is nice to start to see some of the folks who are in Latin America start to really get a lot of uptake and interest. Like when I was looking in 2017 and 2018 in LATAM, because we've been doing like Voila and Contabilize and a ton of other startups. And at Point 72, it was really just us, and we'd have like our 4 or 5 folks. And I remember our partnership, and everyone went to Latin America. Yo, like the world's changing. For the first time, there were all these people in Uruguay just talking about tech. Now it's like everybody's doing it. There are people whose like entire function at their firm is just to have international coverage, which is phenomenal. So yeah, I definitely think that we probably got like maybe another year or 2 of runway before it's like effectively what we look like in terms of consumer fintech. And I can't speak as well to broader tech as what that looked like and call it 2019. Or it's you need to go find alpha somewhere else. Like we like to decide unless something has incredible breakout numbers or unless it's the enablement infrastructure, like you're better off looking at emerging markets. One thing that I want to do is, so one thing we do on here is we call out gems. And you all, I believe it might have been Ryan, but I might be wrong. You made a point about how you all are consumer investors. However, if you need to invest in infrastructure or a B2B company in order to get something to an end customer, then you're effectively still a consumer investor, right? That is just you investing across the life cycle of your thesis and impacting consumers. And I think about this pretty often that like mostly everyone is at the end of the day a consumer investor, right? Because like every company is
100%.
And that's like something that I think all investors should just take a moment to step back and breathe and realize that stop downing consumer. All you're doing is figuring out other people are selling to them. I guess it's a distribution question more than it is customer segment question, in my opinion. With that, I'll stop being philosophical and jump into it's pretty obvious to us in the audience that you all are pretty mission focused, but like you all put that in your creed. Like you all are mission driven fund that backs mission driven founders. Can you talk about what that actually means? Because I think that Kairos, if you back up from the fund itself, was very much so into that. And I think that's in your DNA. And you all are a really good example of what that really means.
100%. Yeah, it's basically flowing through our veins. Since we started Kairos, we've always been pretty excited about profit following purpose. So having a higher order that you're basically focused on and delivering for, whether it's your employees or whether it's for the consumers or whether it's for the planet from a sustainability factor, and something that we're looking into more and more each day. Now, this is super hard to do, to be honest, and it's very hard to do when you're reading, I don't know, any one of the many tech VC blogs where you're seeing all these companies raising tons of capital. And a lot of people will say, like, one will suffer in the pursuit of another. So if you're seeking profit, the purpose will suffer. If you're seeking purpose, like the profit will suffer, or you can use purpose and mission interchangeably. Now, I fundamentally believe, and the reason why we ended up starting our funds is because we believe that the best way to do this, like the way in which we structured it and the way in which we like put our thesis together was all based on like, how could we solve the biggest problem for the most amount of people? And as you pointed out, our thesis is to make life better for the 99%. And we focus on finding those founders that are fixated on this higher order mission and have the ability to execute. And that's like full stop. That's what we do. This can look very different for a healthcare founder versus somebody in education. But as long as we can get aligned on mission with the founder, like everything else is gravy. Like even in our investment memos, like from day one, we knew that we were going to have to indoctrinate people into like help, like whether it's interns or associates or et cetera, we actually would have people fill out, who is this customer? What is the problem that this particular company is solving for this customer? What is this, like, what was this customer doing before this product actually came up, like, about? Like, why does this need to exist? Why does it need to exist now? And we go through this whole entire thing, and we basically took the FOMO out of the investment analysis. So it was like, it didn't start with, okay, who are the funds that are in and how fast is this deal moving? It was much more on the, what is this company or product or founder going to do for the world or for this particular consumer? We, for instance, are focused on like the 99%, or we've said the everyday consumer or the masses. It's all pretty much the same person. It's the person that has less than $1,000 in their savings account. They're spending 85% or more of their paycheck on things like food, transportation, healthcare, housing. You add childcare and you add student debt in there, and like the whole paycheck is gone. And for us, like, there are a few funds that are investing with the mission-driven thesis. There are very few funds, I would say, that are investing with the mission-driven thesis. There are more popping up now than there were a few years ago, which is like super exciting to us. Like, we're very much, I would say, collaborative and want rising tides raises all boats type of thing. But we, like, from the very beginning, and as we build out K50 Ventures, we aim to be the fund that are mission aligned with our founders, and we'll continue to be the one driving their mission forward, even as they hit bumps in the road, which are bound to happen. I'll kick Adriel. I'm sure you have some other stuff to add, but that's where we lie when we're thinking about this.
Yeah, 100%. Yeah. So my take on this is, even if you take a step back and look at some of the history of venture capital back years ago, when you saw these funds starting to pop up in Silicon Valley, what they were doing was really following the best talent out there. And I think VCs falsely get too much credit for investing into people, but it's really the founders that are building these companies. And while the best founders, historically were maybe building new technologies, the internet, mobile products, et cetera, the shift that I've personally seen in the last decade working across the startup ecosystem is this new wave of entrepreneurs. And these are folks who've either exited companies, these are people who've helped grow unicorns, people who are really setting out to start their first companies. And something that is happening is they want to set out and solve some of the world's largest challenges, whether that's around healthcare, education, fintech. And so for me, as I've started to engage with some of these founders, I think the common thread here is that there's a different level of passion and this unbarred energy to solve these problems. And ultimately, you want to be able to back the best possible founders. And I think across the board for our team at K50 is we're starting to see that these individuals, this archetype or profile of founders being mission driven.
Yeah, it's interesting that you say that. It almost goes back to what you were saying earlier, Tyler, which is like the infrastructure needed to exist in order to even deliver these consumer products and services, which we're now starting to see. Or you could even say, honestly, people probably just got bored, and or like the competition got too stiff within some of these other sectors. And so now they're starting to say, you know what, maybe I'll go build a company in education, which is, we love seeing that. So we're super excited for the next couple of decades here. And we think that the next, $1 billion, or call it decacorns, are going to be in these, like, going after these kind of bigger, more societal like issues. The fact that healthcare is super expensive and it's the #1 cause of bankruptcy in the US. And that's just ridiculous.
Agreed. Totally agreed. You all have this one company that I love. What is it called? Brella, which is like the supplemental health insurance for all.
Yeah, absolutely.
Phenomenal company. Phenomenal. And you're spot on. Like lowering costs, aligning payment infrastructures, incentives, shifting towards value-based versus effectively margin-based, if we're going to call it what it is, and legacy comfort-based, if we're going to call it what it is huge. I think that all those things are huge for just like the way that people live. And really, again, because VC tech and a lot of the folks who make these decisions and are positioned to even have the wherewithal and connectivity to be able to start a company don't live in the vast majority of the world. Like they live in these bubbles. They don't even think about these things. So you're just doing a lot of good work. And I'm personally thanking you for it. Let's see. From here, let's talk a little bit about something that we hear about a lot, which is first there was like the A's heating up, the C's heating up, and now like the pre-seed itself is heating up. Just as competition increases, like you just see it naturally, right? Like public market alpha dries up, private equity alpha starts to dry up, the growth stage investors, then Series A now, C now, pre-seed. And it seems like you all have figured it out. Can you talk a bit about like how the craziness and velocity of investments in the pre-seed market is evolving and how you've seen these founders, like some of them get ridiculous valuations from day one, but others end up taking several months and hundreds of meetings to close their like much smaller rounds. Like from your perspective, how do you think about raising your pre-seed round as a first-time founder versus a second-time founder, especially given that Kairos has a lot of both?
I can take that first, and Adriel, I'll let you take the latter part of the question. So we were like, from day one, I kept pushing us to be extremely quick when it came to making an investment. So we try to be as quick as possible, and we try to offer at least a yes or a no, like very quick, and say, this is why we're not interested in this. And most often it's, this isn't a thesis fit. So we try to do a lot of our upfront prep work before we even come into the conversation with a founder, which I think founders like, and it makes it easier on them. So we're okay with the velocity, I guess is what I'm saying. And there's a lot of problems out there to solve too. So I get why there's a lot of founder, and right now it is wild. We did 11 investments in Q1. I get the velocity is crazy. I think the one thing that I will note, as far as, first of all, if you look at first time founder versus second time founder going out to raise capital, the second time founder more often than not is going to have, like, the numbers are going to be bigger, the valuation is going to be higher, they're going to be able to raise quicker, and that's just because they have the relationships. I fundamentally I can't look at some of these fundraisers and be like, oh yeah, I totally understand why that happened, in terms of like why so much money came in at the valuation. I get it from a perspective of there's just a lot of money in venture right now. And so these bigger funds are trying to go down market so that they can be able to invest sooner, so that they can put in more capital as the company grows. I totally get that. But for some of these things, I'm not sure what's going on in the heads of some of these investors. I'm sure they have a reason for it. They're not stupid. What I always tell first-time founders is make sure you get a few investors that really know your space, or potentially are just high profile. You could go either route as a piece of validation, so that when you go out to raise officially, it makes that process easier, and you can run a process within 30 days. This is what YC does. Like, that is YC. Fill in, get a few investors that really know their space as a piece of validation with go to YC. It'll cost you some equity. Plenty of companies come out of there and they raise it at higher valuations. So I do think it's very worth it. I guess you have to, it depends on your situation, but that's what I tell most first-time founders. The other big piece of advice is raise a smaller pre-seed. Like, don't get caught up in not every founder nor every company is cut from the same cloth. And I think everybody has to do it their own way. It's totally cool to go raise a smaller pre-seed from friends and family, us, and prove out your thesis a bit, build a product and get something shipped. And then I think you'll be able to have better options for investors, et cetera. For second-time founders, for the most part, I feel like you've learned all that you needed to learn in that from doing it the first time. I'm not sure what the best advice I can give, except have a few previous investors invested, or else there will be this big question mark as to why this didn't happen.
Yeah, I'll just quickly add to that. You have to write the founders market right now. Right? There's no question about it. Money is just flying around for nearly anybody. For second-time founders, the pre-seed round is effectively a seed round. We're seeing companies that are a month old, pre-seed companies, haven't yet figured out their business model or even really the long-term vision, raising $5-6 million seed rounds because of their second-time founder. I think it's something that I've been pretty proud of our team in terms of just being disciplined, even with this market uptick, even during the pandemic, as a lot of investors just held off. We kept in our lane. We focused on the problems that we wanted to solve and the best founders building them, regardless of their pedigree, their background, what their experience was. They're building a multi-billion-dollar company solving a problem that's impacting whether it's global society or 99%, and a real sustainable business is being built. We're excited to support you. And I think at the end of the day, like, there will be a reckoning for some of these founders who, are raising a ton of money and enjoying the benefits of this founder market, but have yet to build a real business here.
On point. You're very much so on point. I was having a comical conversation with a buddy of mine recently. And we were like, maybe this is just like natural inflation mixed with an increasing wealth gap. Like, what if it's just natural that things are supposed to be like getting bigger on a per round basis? And we definitely are like over indexed towards the heavy side here. But what if it's just a natural evolution of what the space is? But outside of that, like, little comedy piece.
Actually, let me ask you: what do you think this is? Do you think this is a new normal, or do you think there is going to be somewhat of a correction that we're going to see in the next 6 to 12 months?
Okay, so I'm actually going to ask Clay to chime in on the back end of this. So there is this post that we looked at on Twitter that to me was like, it just shifted the way I was looking at the world. Clay sent it to me like 2 weeks ago. And effectively, what we're finding is that the cost of building things is going down dramatically because of the infrastructure pieces being built. And we don't think about how if you build a piece of infrastructure, just how much can be built on top of it. We're seeing that happening simultaneously across every type of function needed. All the skills that are needed that were really challenging to build before, there's an abundance of them, whether it be like no code, whether it be app in a box, whether it be an API for whatever feature you need. All those things exist. So what actually is happening today is that, okay, all you have to do at this point is have like a basic understanding, like a PM level understanding of like how to build things, and then be able to identify a problem. When you combine that with the fact that at this point you have infinite information on how to identify whether or not a problem is worth solving and a ton of access to capital, you start to think that someone who is at the pre-seed or the seed technically has all the resources at their fingertips immediately, as someone else had to build out with tons of capital until they were ready to be at their seed plus or A. So it's not ridiculous if you're looking at what can be built at the pre-seed with relatively little capital. If you're just looking at it on paper versus what a series seed plus or series A would have looked like, call it 5 to 10 years ago. So if you're looking at just investing in an asset and you're not making it relative to its peers, then it's not crazy. I actually think that makes a lot of sense. But that being said, it is relative, and we haven't really shifted the way that we invest in our capital structures or our capital pools. Some really lucky investors have and scaled their AUM. But that itself, to me, makes it to where like there probably should have been somewhere in between where we are in terms of it being overinflated versus like just natural inflation. Like we probably should be somewhere within that spectrum. And I don't think that it's invalidated. And the last piece on that is just the same way that the tools to build something has come to fruition pretty quickly. The pipes to get these tools or these companies to their customers have also developed rapidly. So like scaling revenue and like actually being able to get to where you're seeing all these companies like within less than a year's time being worth $500 million, and some of them not at crazy revenue multiples either. There was a time where like Juniper Networks doing their revenue growth was like unheard of. And now maybe that's possible if they get the right distribution channels and partners, and they actually have built the product to be scalable from day one, or they're building it on top of some amazing infrastructure that was launched in 2017. So I don't think it's crazy. I think investors just need to have the discipline to see if that's real or not. And
100%.
Clay, if you have any thoughts there, please share. Oh man, we might have lost Clay.
I had to unmute myself. Yeah, I don't know. Like, I'm still really early in my career, so I haven't seen these boom and bust cycles. But the way I'm thinking about it right now and this could be the wrong framework, but it's what I'm using to think about it, is the Fed has essentially said they're going to keep rates at zero until at least 2023. So that completely disrupts traditional portfolio theory of just how the general asset manager or just regular person in general puts their money to work. So you've essentially eliminated half the equation. So you can't put your money to work in bonds. You can't put it in cash. You can't really hold it in anything other than equities. And at the same time, public equities are trading at all-time high multiples. It seems like a lot of the stuff there seems really frothy. So now you're seeing a lot of asset managers or just retail traders in general going into alternatives, which is really interesting. And I think we're only at the tip of the iceberg there. It's the reason why crypto has exploded in the last 12 months. It's the reason why US dollar continues to be devalued by the day. So as that comes to fruition more and more, I think there's just nowhere else to put your money to work. I think the biggest question I have is, especially at pre-seed and seed, I just don't know where this money is being used as a founder. Like, you're raising 5 to 10 million plus at the pre-seed without a product. I guess you have to build out a product team. That's pretty expensive. Put into sales and marketing, which is a black box in terms of trying to find targeted ads. But like, your retail or your real estate presence is gone. You don't need to buy any office space. At least most startups are preferring not to. So I think that's the biggest question I have. Like, I haven't really dug into it that much with founders. Just like, you are raising these massive rounds, where's the money going to work?
Yeah.
But something to consider. I don't have an answer for it.
I think you're 100% right. As far as where it's going to work, I don't think the founders can actually pinpoint exactly what that is. I think what they're doing is they're just taking more swings on more like riskier experiments. Instead of doing one experiment, they're doing 3 at a time. But that would be my guess. Hopefully it's going somewhere productive.
Yeah. No, it's interesting. Time will tell.
By the way, Bitcoin just hit a new all-time highs while you were talking. 60, almost 64, 63.
You're lying.
Tyler, it sounds like you are an active investor in Bitcoin.
I'm like, I would call 40 to 50+% of my liquid cash is in Bitcoin and Ethereum.
Yeah.
Love it.
I'm pretty.
Sounds like we're talking to an upcoming LP.
I mean, I'll be your LP if you be ours. Let's do it. Isn't that how Silicon Valley works?
Yeah.
But yeah, I'm actually just like full of glee right now. So I'm gonna do some jumping jacks or something. Clay, can you jump into the speed round? And I guess before that, if you all or Jessica, who decided to be quiet, who's awesome, have any questions for us, go ahead and ask, and then we'll kick it off from the speed round.
No questions from me.
Let me ask you guys something, and we'll get into this in the speed round in probably a second. But as you guys have started to build this almost professional development community and network, which I think is incredible, is something that I wish I had before I got into this career and in the beginning of my career. What is 1 or 2 pieces of insight that you've been able to pick up on as you started to see this is really, from my perspective, it's a new industry that's emerging, right, in terms of venture capital. So what are 1 or 2 learnings that you've had building this community?
Tyler, you want me to go first?
I'm still doing jumping jack.
All right, I'll try to simplify to call. I feel like I've learned so much over the past 9-10 months, however long we've been doing it. But I think first, realize the power of curation. I think there's endless amounts of information on the internet. I think people stop and take a look at what you're doing when you do a lot of upfront work of curating resources, links, something else. It just helps people find what they're looking for easier. That's kind of how we got our foot off the ground, building this aggregated resource library in a previously opaque industry. We've learned firsthand how powerful onboarding messages can be. That's something we're still playing around with daily, figuring out how to best provide new users with information that matters to them, and then try to get them to steer them towards doing the action steps that we would want them to do, which is be active and engaged within the community we built. That's something I just, before this, never really spent that much time thinking about it because it's not the sexiest topic in the world. And then lastly, just say that like we're experiencing every day how powerful communities can be, especially online communities. I think that's becoming a bigger buzzword recently. But community maintenance takes a lot of time. Takes a lot of time to build that up and make sure that people are posting in the right channels, making sure everything's clean and not messy. I think everybody's involved in a number of Slack groups where that isn't always the case. So we've learned firsthand just how much work that is. But if you do the upfront work, I think people do appreciate it on the back end.
I would echo that. And then I would also I want to say that like this model is emerging. Like you'll see an On Deck exist, which is effectively a community that's evolved into an educational platform that's evolved into effectively like a fun-ish / business-ish / somehow investors believe it'll become $1 billion something company-ish thing, which is phenomenal. So shout out Eric. But let's take it with the business aspect of it. I think what I've learned is just like how human this whole industry is, and how if you just break down what each of these things is, like when you look at what Clay's talking about, of like if you just make it easy for people to like get what they need and you well curate it, it's just what I'm seeing is like people who are normal in a space needing to learn and figure things out and be vulnerable and connect with their peers who are experiencing the same thing. And what I've noticed is whether it's someone who's like a buddy of ours at a Cell or a Greylock or someone at a firm we've never heard of, they're all trying to figure out the same exact thing. Like, how do I get faster at making investment decisions? How do I like actually take a step back and look at what's actually happening in Latin America? How do I actually support a founder who probably knows more about this than I do? There's all these things that if like you just keep the human element in, you win. So like me and Clay had this moment where we were building something, and I'm not going to name drop what the thing is, but we realized that the reason that we weren't seeing as much success on that particular thing is because we weren't truly serving our audience. We were serving an adjacent audience that wasn't our audience, and it just wasn't picking up the steam. And it was a huge brain suck for us and energy and emotional like carnage piece for us, because like we don't even truly understand this problem because we are VCs. We identify with VCs. And I think that what we're learning is that like as we build this and like as it like takes on a life of its own, because at this point we don't even grow it, it just grows on its own and people are contributing. Everything is UGC at this point, or user generated content, for those who are listening who don't know what that means, because we do have some like non-VC folks or VC folks who don't focus on companies that do that. Like as long as you continue to understand the human element, and then as K50 does, as long as you're looking to serve the broader community and improve their quality of life, the profits or the benefits, and whether that be social, political, cultural, et cetera, profits, they'll come. And that's what me and Clay are learning. And as two young, arguably entrepreneurs or community leaders or investors or even operators at this point, because I think both of us are starting to do operating roles as well. That's a key lesson learned. It's just focus on your audience and the human piece of it, and everything else will follow. You have the tools to enable, I guess, the mitigation of stress for your audience.
Yeah, I appreciate that.
Yeah, so
Cool.
Clay, you want to kick us off with these quick fires? And don't forget, we always forget, in doing so, at the end of this, we also want to hear who you want to have on the Confluence Community and podcast.
Oh, interesting. Okay.
Cool. So I'm gonna just run through these real quick. So we have these at the end, call them quick fire questions, meant to be answered in 2 sentences or less. First one we have is, what is a recommendation you hear regularly that you think is bad advice?
I can kick this off, Ryan. Lately, I've been hearing a lot of investors tell founders to raise as much as they can right now. Yes, it is a founder's market, and probably it's a bit easier to raise money than usual, but I think that strategy is going to backfire. So my advice to founders is always raise the amount of money you need to build a business, raise the necessary runway to get there, improve your milestones up.
Yeah, we've seen some of the same and heard some investors give the same advice. I think another thing, just kind of along the same point there, is to understand safes and convertible notes, because we've had a lot of founders, at least a pre-seed, I've worked with some in the past, that have just raised on 3 or 4 convertible notes. And then once they finally get that equity raise, they realize how much they diluted themselves.
Yeah.
Same vein there. Okay, so next one we have in the last year.
On that point, really quickly, I just think that one, if you do need to think about dilution and protecting yourself, But what I would say is like founders who do decide to raise a ton of money, just be smart about how you spend it. Like at the end of the day, you have to grow into the milestones needed for you to get to the next round or you're going to die. So if you get a ton of money, be incredibly disciplined with how you spend it, especially those who've already decided to take that leap.
Agreed.
All right, next one. In the last year, what new belief, behavior, habit has most improved your life?
I forget what book this was. Somebody mentioned it to me. I forget what book it's from, but if it's not 100% yes to no, and that is a belief. And then I got rid of my apartment in October, and it's been super liberating. That's also been a behavior that's happened over the last 6 months.
Are you nomadic right now?
Correct. Yes.
Love it. I'm nomadic too. I'm never
Nice.
going back.
I'm going to be nomadic starting next month, so maybe I'll have to pick up some tips from you guys. But just to answer this question, it's a bit cliche, but I can't tell you guys enough of how much it makes a difference. But meditating, and I think life is just moving so quickly right now on a lot of different levels, and to just take a moment to pause and just be in that personal space is something that I've found to be pretty effective for me.
Yeah, we've heard that from a couple of guests, and Tyler, I don't know if you do it. I'm terrible about actually stopping and doing that myself because like you literally only need 5 to 10 minutes a day to do that and just center and just realize on the stuff that matters. So stuff you can control. I need to get better at that myself, but now we've heard that answer from a couple of people. I should probably take that advice.
It's not easy.
There's a little podcast that, one of the podcasts that Deepak Chopra has. And he does 10-minute podcasts. I forget which one this is in particular, but he talks about morning routine. And in there, it's like a 5-minute morning routine. And it includes like somewhat meditation, but mainly just a little breathing and like having gratitude. And I've recently started to employ that, and it's been incredible. And not looking at your freaking cell phone like when you're right when you get up, and or having it in bed next to you and going to your email automatically. First of all, completely wrecks your circadian rhythm, and second of all, I think it can throw you into a spiral right when you get up, which is not good.
Totally agree. I decided like a month ago that the cell phone will become obsolete and that I'm sick of it and I'm just over it. Holograms or something ASAP. Like I just can't do this form factor. I can't keep living in a box.
Yeah.
It's so not cool.
In a business card.
All right, cool. We got 3 more here. So it's on the business side, aside from having to say no all the time, what's the worst part about venture?
For me, it's so clear. It's the egos. On both. I mean, I'm sure I have one too. So I can't escape it, but it's just, you can get caught up in this. I think a lot of us get caught up in this kind of masters of the universe situation, especially as an investor and or as a second time or third time founder. And I think that's when I come across it, I just cringe. I'm like, oh, I can't do this. I don't want to talk to this person. But
100% agree. I think, and it goes back to your point, Tyler, around this is a very human industry, and we forget about that sometimes. There's just way too much. So I 100% second what Ryan says, and I'll add to that on the venture front, the lack of professional development in terms of the resources and mentorship available to be successful in this industry. And a lot of that is due to these egos and to the support system that people have. So I think that, again, hats off to you guys of thinking about building some resources and tools and support system for people in this industry.
Yeah, we're trying our best. Yeah, I mean, like the thesis for us of starting it was like we wanted something like this because it didn't exist, and we struggle with everything you guys just laid out there. Like we didn't really have, at least I'm speaking for myself here, I didn't have like strong mentor network, especially coming from a non-target area. Didn't really have any insight on what would be best practices for me to like actually move up the chain and succeed in the role. So I agree with all that, along with the fact that like some people in this industry are just not very relatable and tough to talk to. But I think it's getting better. We've met a lot of really cool people. There's a couple bad apples in there, but for the most part, we've only had good interactions. But know what you're talking about. All right, so got 2 more here. So a lot of the audience here is junior-ish within their firm, so analyst to principal level. What's your best piece of advice for junior VCs or those aspiring to break into venture?
Why don't you go first, Adriel?
Oh man, we can have a whole conversation around this. I'll keep it short. We'll try to meet with as many founders as you possibly can, whether they're raising money or not raising money or already have successful businesses. Going back to our point around all of this activity, especially at the early stages, and this kind of idea. There's so many companies raising a ton of money, valuations are super high. The one kind of common thread here is that the successful companies over time is based on those teams. And if you can start building your pattern recognition, start building your insights and creating that profile for yourself of what a successful founder is based on these characteristic and trait through characteristic and trait identification of meeting founders, and lean on that will make you a successful investor.
All right, so I have two I call them like pocket tricks, something that you could potentially go and put into practice immediately. One, if you have $5,000 saved up, which I know a lot of people don't, but if you do, take $1,000 and go and actually place some angel investments yourself. I think it's always good when a young investor comes in and says they have already made angel investments. Make sure that the investments are awesome. And I think that you can honestly put in like $1,000. If you're helpful to a founder, they'll let you do that. Especially it shows that you can source, it shows that you can build a relationship with somebody. It shows that somebody's willing to invest for $1,000. If you can't do that, I totally get it. I was definitely in that boat. I would go and work for free for a great angel investor. And I specifically say angel investor for two reasons. One, on Adriel's point, being able to meet as many founders as possible. So there's two things about working for an angel investor. One, angel investors don't do this full time. For the most part, they don't. They're always looking for somebody to help with deal flow. Now, you need to be friends with this person or else it just would be almost impossible to do. But if you can, a cold email can go a long way. Most of them need this. And I think you'll have a leg up on deal flow where you'll get to wear, quote unquote, like the family office hat, where you'll be acting on behalf of this angel investor, which I think is not something that a lot of I would call early investors have thought of or would do.
Let me just add one more thing to that. So if for those who may not have the capital or feel like they have the connections that to do either of those things, you can still do the job of a VC without being a VC. And what I mean by that is exactly what Ryan's mentioning: meet with as many founders as possible and build a quote unquote portfolio, right? So companies that you invest in, and maybe even write little memos with them, even though you might not exactly invest in them, but you're still going through that process of having a meeting with the founder, learning about the business, processing, analyzing, the individual and the opportunity. And if you build that portfolio, maybe it's 30, 50, 100, 200 companies over time, then you're already starting to build that skill set as an investor.
Love it. That's great advice. Yeah, I heard none of that when I was coming in. I wish I would have. That would have helped me probably get on a better trajectory. That's awesome. So last one here, aside from I'll let Tyler handle the very last one, but last one from my end, who's a mentor that you'd want to give credit to?
Mine is pretty easy. It's Alex Fiance, who's been my business partner for the last 5 years, but he's always been there for me in personal and professional challenges and opportunities, and really helped me with getting K50 Ventures off the ground. And he serves as our board member, and it's been great getting to work with him for the last 5 years. So hats off to you, Alex. Thank you for the late night calls and the early morning texts.
I would say this is an interesting one, but my twin brother, he's a CEO of a company, and man, that guy's always keeping me grounded. Like the amount of grit and hustle I see and resilience I see from him as an entrepreneur is always, and having that kind of daily conversation, weekly conversation, regardless of time, about whether it's his challenges, my challenges, and having that support system and him just keeping me honest it's a special gift that I'm super thankful for.
Yeah, having a twin that's on the other side of the table, I feel like that's a competitive advantage for you. That's awesome. That should be baked into the pitch. Yeah, wait, Tyler, you got one more.
I was going to say, the drill, last question. Everything we do is for the community, by the community, UGC. Who do you all think should be in the Confluence community that may not be already? And who do you all believe would be very interesting for our venture capital community as a whole to know more about on the podcast?
So I have a group that I recently met that I really like what they're doing. They're young guys. I think they're doing something pretty special in Brazil. It's called Norte Capital, Norte Capital. They've basically gotten like all the top founders from Brazil to be LPs in the fund. I don't know how big the fund is, but they've been incredibly collaborative, even though like we just met. I like the way they think. They're smart. I think they're doing something very cool for the Brazilian startup ecosystem and in Latin America in general. So I'd toss their name in the ring.
Oh, go for it. Go for it.
Yeah, happy to.
I don't know if you guys have brought on board anyone from the Left Lane Capital team, but yes, I think in terms of just, I'm obviously, I think Ryan and I are examples of this, but I'm a big fan of kind of the young investors building their own funds, being entrepreneurial, kind of rustling the feathers of traditional venture a little bit. I mean, I think those guys are doing something, pretty exciting and in a similar boat, a little bit later stage than us.
And then one of our former partners at Kairos actually went out and started her own fund recently. Like I think she
get her on.
Just
sure.
did the first close. She's incredible. Her name's Katie Shea. The fund is called Divergent, and she is a really great partner. 2 female VCs that I think are going to take the pre-seed kind of seed stage by storm. So I would also talk to them.
Would love to. Yo, question for you all. This is a tangent or like a side note. I will probably leave it in the podcast because why not? But you tell us if you don't want us to. What are some tips you all have for young people raising funds? Like Clay and I are technically raising a small fund, and it's kind of like you're shooting in the dark. And like every day you're like, dude, I can't believe we just talked to this LP, or like, dude, we actually are pulling the trigger here. And for us, because we're doing a partner syndicate model as well. So we're arguably making this decision in front of 1,500 people every single time. But how do you all, or what do you all advise that we do to, make sure this process runs smoother, or like tips that you all knew or wish you had earlier on in your process?
I'll say one quick thing and then let Ryan answer this. Between the two of you, just keep the communication channels open, and the more you can communicate between each other and I think be aligned as you build this, that I think that you'll have a lot of support going through this.
I feel like this is a longer conversation, but I think some of the main points is that I think are often overlooked. One, most of the investors that are going to back you in your first fund are people that you already know, period. You will get on a few new investors. I think that you might know tangentially, or you might bring on a few investors from the people that you already know that are already going to invest, that are going to introduce their friends. But by and large, the people that are going to invest in your fund are people that you already know. 2, don't sleep on your friends that are also VCs. I think there's lots of folks out there that would be willing to throw in a little bit of money into a first-time fund. Most of the time, first-time funds from emerging managers often perform the best. So as far as like looking for alpha in an asset class, like getting into an early stage first-time fund by 2 folks like yourself, I think is something that a lot of people might want, that you already know, again, that are not your traditional LPs who are going to throw in $1 million. And then 3, I would just be very clear on what you're investing in, why you're investing in it. Like why you is why you, and how does that change over time, and what is going to be your true north star. I think those are my 3, I would say 2 pieces of advice, one around fundraising and then one around just general strategy. And happy to send you a fund model in case if you don't have one that you're working off of currently. I've gone through a bunch, and it's always helpful because it just is you can test a bunch of different strategies with this model.
Yeah, that would be really appreciated. I just saw one in Trace Cohen's email, and I built one for us. And it's okay. It's not like the best.
Everyone has one, and then you get something from like a friend that's I got it actually from an LP who clearly would just plug in.
Guys, thank
Well-
you guys for having us. Tons of fun. Let's definitely, continue the conversation offline. I'm sure we have some exciting things to collaborate on.
For sure. Have a beautiful
Great.
day.
Guys, have a good one.
Huge thanks again to Ryan and Adriel for coming on this week, and we hope that each of you are able to pick up something valuable from this talk. If you're looking to get in touch with either of them, we've linked their bio and their social profiles within the description below. You can also find their contact info within the Confluence VC directory. For next steps, if you're an investor and have not already signed up to join, we encourage you to check out our website at www.confluence.vc to submit your info to become a member. If you have any feedback for us, please feel free to reach out directly either to Tyler at gpv.com or myself at clay@bunkercapital.com. Hope to hear from you all soon.